So good morning or good afternoon, depends where you're joining us today. Few housekeeping items before we start. So this session is being recorded, so we can provide recording to people who have registered after the session. And everybody is muted, so it improves the quality of the recording as well. But you will not be able to see participants, but you will be able to see presenters. So if you have any questions, you can type them in the chat and we'll go through them later. But also we've got some of the questions before the session, so we'll address them too later after presentations. So today's session is all about businesses and business owners, and we have excellent speakers today. So I'll introduce them. We'll start the day with Rob. Rob Welke. He is a Chief Value Officer with Proactive Business Solutions, Inc. Robert brings over 35 years of executive and management experience, consistently making significant impact on every businesses that he has touched. He is a seasoned leader with track record of starting, scaling, and ultimately selling several companies across various industries. Robert's deep expertise in leadership, strategy development, financial acumen, change management, human resources, and operational excellence positions him as invaluable assets to any organization. And Rob, I'll introduce Eric as well, so we can do introductions right now, and then you can take over and start presentation. But we also have Eric, Eric Freilich, I'm not sure, maybe you can correct me later, but
hard C, Freilich.
Okay, Freilich, thank you. Eric, he's a director and legal counsel for BMS Private Equity and M&A practice in Canada, and he advises on insurance matters in connection with various types of transactions, including M&A, restructuring, and reorganizations, as well as litigation finance. Prior to joining BMS, Eric was a corporate lawyer at Davis, Ward, Phillips, and Winneberg in Toronto, where he focused on mergers and acquisitions. Eric is a graduate of the MBA program at Osgoode Hall and Schulich School of Business, and he started his legal career at the dentist office in Toronto. And I'll be the third one to present. Basically, I'm with Colburn Group at IG Private Wealth Management as an associate. I've been with current company for over 10 years, and I'm your finance guy. So I guess I'll pass it on to Rob at this point.
Good morning, everybody. Let me share my screen. All right, can everybody see that? Alex, can we see that?
Yeah, we can see it now.
So good morning, my name is Rob Welke, and I'll be talking about understanding business exit planning and why preparing for your exit is going to be critical as a business owner for your retirement. Uh-oh, there we go. Okay, so who am I? Well, Alex gave a quick overview, but here's a little bit more of a summary about my background. Started 5 businesses in the last 35 years, sold 3, was a financial planning advisor for 10 years, and I've been doing this work as a business value accelerator for the last, specifically for the last 6 years, but I've been doing it pretty much all my career. What if I came to you as a business owner and I said, I want to buy your business? I bet you'd say, yeah, I'd love to sell it, but here's a couple of things that are true about what happens in that case. First of all, business owners generally aren't ready to sell when somebody comes along and asks them to buy their business. So 2/3 of business owner sales are due to one of 2 things. The owner or the family member gets sick and the owner is forced to sell, or somebody comes along and says, hey, I want to buy your business, but you're not ready. And that's exactly what happened to me in my last company. We weren't ready, and because we were not ready, we lost the deal. So, problem we have in Canada, 76% of Canadian small business owners want to be out of business in the next 5 to 8 years. That represents roughly around 800,000 businesses in this country, yet the reality is less than 1 in 10 businesses is able to sell. So what am I going to talk about today? Today we're going to talk about what is exit planning. I'm going to talk about what are value drivers, what is best in class, what is the profit gap and the value gap, and what is value acceleration and how it can impact your business. So what is exit planning? Exit planning is a complete strategy for exiting a privately held company that focuses on financial, legal, tax, repercussions of leaving an organization, selling, transferring to a family member, maximizing business value at time of exit, making sure that the business owner has a personal plan that they're going to enact once they leave, because if they don't have a place to go and a purpose after they leave their business owners tend to fall back to some bad habits. Evaluating and identifying the best options for a business is part of the exit planning strategy as well, and creating best-in-class operations around financial performance, operations, and execution. And what we want to do is we want to enhance what we call exit readiness and exit attractiveness. So when you're an exit planner, there's a broad base of knowledge that you're required to have some understanding around financial management, understanding what value acceleration is. We're going to talk about that a little bit more depth. Operations management, understanding tax optimization and that it plays a role in what you need to do, understanding all the different exit options that are out there and the different types of strategies you can execute. And then you also need to understand about strategic planning, execution, and understand about human capital optimization. So when we talk about value drivers in a business, what do we mean? Well, there are 5 key value drivers in businesses. First one is financial performance. If you don't have profitability, you're not even in the game. So you need to have profitability to start. The next 4 things are what we call intangible capitals: customer capital, social capital, and structural capital. Customer capital is your customer diversification, your customer depth, your customer tenure, and loyalty. Social capital is all about your brand. Structural capital is all about the things that you need in your business to make sure your business can run effectively. Systems, processes, procedures. And human capital, of course, is your people. Do you have the right people in the right seats facing the right direction? So when we talk about helping a business get ready for a sale, in our business, we talk about focusing on becoming a best-in-class business. We want to drive towards best-in-class because best-in-class gets you the top end of the valuation if you're looking to sell your business. So it's a term we use in business that denotes that your company, product, or service is considered superior versus all of your peers in the industry, and means that you've focused on building all the things that drive that excellence in the business. So best-in-class companies typically have higher average profit, more effective client-facing systems, better brand, strong teams, and well-diversified customer base. So why is it important to you? Well, understanding what best-in-class means that you can actually peg yourself vis-a-vis your competitors and your peers in your industry around the profit gap and the value gap. And what is the profit gap? The profit gap is the difference between how a company performs today in terms of profitability versus what it would look like if it were operating at best in class. And yes, we can actually identify what a best in class company looks like in terms of profitability vis-a-vis their peers within their industry sector. It is a relative comparison, but the ideal is best in class companies have optimized and enhanced all the value drivers in their business that ultimately drive business efficiency and that effectiveness towards profitability. So when you compare yourself in relation to best in class, where are you? Vis-a-vis the best companies out there. We need to understand that because understanding the profit gap leads us to helping us understand the value gap. And the value gap.
Can I interrupt you for a second? Sorry, we've got a comment in the chat. Ben is asking if you can slow down, please.
Okay.
Sorry.
Well, yes. Let them know they're getting a copy of this as well. So
yeah, for sure.
Value gap. The value gap is the difference between the value of the company today versus what a best-in-class company is in your industry sector. So again, it's a relative comparison, but we can actually identify this. There are actually statistics out there in the marketplace where we can pin this number. So best-in-class companies, as I've mentioned, have optimized and enhanced value drivers, focus on value enhancement and not lifestyle income. If you look at that chart on the right-hand side, Value companies that focus on value acceleration and focus on best in class have way higher value than lifestyle companies. So what is value acceleration? Value acceleration is the process that bridge the gap and close the profit and value gaps in a company. Value acceleration focuses on that financial performance and the intangible capitals that I spoke about earlier, and it focuses on driving those towards best-in-class performance. So what is the value method at acceleration growth transformation process? It's really focused on the method. It's a methodology we've identified for focusing on de-risking the business, driving profitability, driving excellence in operational performance, creating highly empowered teams, strengthening the market position vis-a-vis their peers, and creating an owner-independent business. Because at the end of the day, if the owner if the business is reliant on the owner, then the business is not going to be sellable. So here's a couple of examples of how we can actually close the profit gap and the value gap with a company. When we looked at this company as an example, this is a case study. Current company's performance indicated that the value is really only about just under $1 million. But if we could focus on building better performance, focusing on value enhancement and getting towards best in class companies have a higher EBITDA, they have a higher valuation, and therefore they get a higher multiple to get that higher valuation. So when you're evaluating a company, as I said, you can look at key things that will help you identify how to drive that company value forward. So this is just a graphic demonstration of that particular value acceleration piece that we looked at. So at the end of the day, in this case, if you focused on value acceleration and revenue growth in that case, we could have actually increased the value of the business by almost 360%. So at the end of the day, as a business owner, your business represents the single largest part of your family wealth, but that value is not going to be meaning anything unless you can find a way to extract it from it. So knowing your profit and value gap helps determine what you must do to accelerate the value. And based on a study by the CFIB, 76% of Canadian business owners want to transition out of their business in the next 5 to 7 years. The study was actually released in 2022. And so this means that there's an opportunity for business owners to accelerate value in their business. There is over $3.1 trillion in North America currently sitting on the sidelines looking to buy good businesses. The challenge is they can't find them. The way that you can make yourself a business that's attractive is through value acceleration. Okay, so having a sellable business equals profitability, attractiveness, and readiness for sale. And only best-in-class companies are going to attract the highest price. So a business owner should be focusing on value acceleration and not lifestyle income. And every business owner is capable of creating their future, but they just must be prepared to do what's necessary to do it. So my recommendation is to business owners, go find your team to help you get your exit the way you want it. A little bit about me, and that is it. I know that was fast, but everybody's going to get a copy of that presentation.
Thank you, Rob. Eric, I guess you can take over, and then we'll answer questions at the end.
Sure. Can everybody see that?
Yeah, we can see it.
Great. Okay, so yeah, very interesting, Rob. I'm gonna focus a little bit more on the actual exit and how that can introduce risk into the lives of sellers of businesses. As Alex mentioned, my background is as a corporate lawyer, and so I worked primarily in private mergers and acquisitions, and so I saw on both sides, representing buyers and sellers, where risk can present itself in the transactional context. I'm now with a full-service insurance broker. That's who BMS is, covering all sorts of different kinds of insurance, and I focus on this really niche area of insurance that looks at taking the risk that's on the parties in a transaction and shifting it to an insurer. So I'll kind of talk about that process as well as where the risk comes from. I think the easiest way to think about risk in M&A is from the perspective of the buyer, only because when a buyer comes in, almost regardless of the negotiation power, they're going to look to put as much of that risk back onto the seller as possible. And I'll kind of explain how that happens. But identifying some of the areas where risk can come from, if you look at the left side of the slide here, I mean, it's things like financial risk. Things that are in the financial statements are not what they appear to be. Operational risk, that can be anything from material contracts that are in place with customers or suppliers are not actually in place, to stuff like the assets of a business are not in good condition. Legal and compliance, there could be outstanding lawsuits against a business or non-compliance with laws. Cultural and HR, I mean, you're looking at everything there from employee dynamics to things like unions, all that sort of stuff. Market and competitive risks, things like maybe compliance with competition laws, and then reputation. I mean, lots of things can have reputational risk, but even something as simple as, you know, there being a whole series of product recalls at a business can damage the reputation of a buyer if they've acquired a company. So the way that we used to deal with these things, at least in the legal arena, is with what are called representations and warranties. And those are simply statements about a business made by a seller. And so, you know, going back to the left here, if you say financial statements are true, well, the information contained in the financial statements is true. That's a pretty good example of representation. Operationally, the contracts that we have with all of our material customers are valid. There is no litigation against the business. There is no union and no evidence of unionization at the employee level. We are in compliance with all the metrics that would give rise to a challenge by the Competition Bureau. And we have no product recalls. Those are just examples of representations and warranties. The point of representations and warranties is, on the one hand, you're trying to memorialize the diligence that you've done as a buyer, right? Because you're trying to compel the disclosure from a seller that if there's an exception to those representations and warranties, for instance, there's no litigation against the company except for this piece of litigation, which I'm disclosing. So you're compelling disclosure, but it also provides legal recourse. And the way that works is in conjunction with the allocation of risk, is you say, if one of these representations and warranties is not true, proves not to be true post-closing, I'm going to create the right for the buyer to sue the seller. So that's the risk that I'm really talking about here. The risk to the seller of a business that something about their business proves not to be true after the fact, and a buyer has a right to sue them. And so what I focus on right now is what's called representation and warranty insurance, or RWI. And that's the insurance product that takes that risk that there's an untruth in a representation of warranty, and it transfers it to an insurer. Now, just to be clear, I'm not necessarily talking about fraud or any bad action. I'm talking about the true unknown unknowns. So there's a mistake in the financial statements. Nobody's aware of that mistake, and it's discovered post-closing. Or operationally, maybe a material supplier has terminated their contract, but that's never been made known to the seller. Or let's say there's a piece of litigation out there, but nobody's ever reported it. So the seller believes the statements they're giving to be true. It's just that it's determined post-closing that in fact they were not true. So this is, at the top here, this is a bit of a flow chart where you're just trying to see the impact of what's happening. So is there a breach of rep and warranty? If no, then the seller receives the full proceeds of the sale because there's no reason to sue a seller. If there is a breach of rep and warranty, then the next question we ask is there insurance? If there's no insurance, then you know what happens. The seller gets sued, or if, you know, to the extent that there have been some proceeds of sale held back in an escrow, then there might be a claim by the buyer against that escrow. But if there is insurance, then the next question we ask is, has the seller given an indemnity on top of that insurance? And what I mean by an indemnity, that's what creates the right to sue. So we might see examples of where there is an insurance policy, but the seller has agreed that they will pay a portion of the deductible under that insurance policy. So what we call a split indemnity. The seller then receives the balance of the proceeds. So whatever they're entitled to under the sale minus whatever portion of the deductible they have paid. And if there's no seller indemnity at all, then of course they receive the full proceeds of sale. So I just want to walk through an example just to kind of to solidify the way this looks. So let's say, for instance, you sell your business for $10 million. Ordinarily, a buyer might ask for 20% or $2 million to be left behind in escrow just in case there's something wrong. And they might say, leave it behind in escrow for 18 months. We'll get our hands into the business. We'll determine if there was any untruth to any of the rep and warranties. And then if there is, we'll make a claim against that escrow. With insurance, you can reduce that escrow sometimes. So let's say, hypothetically, you can reduce that escrow to 5%. There's not perfect coverage. It's pretty good, but there's not perfect coverage. There's a couple of things that could present some risk. So we as the buyer would like you to leave behind 5%. So now you're leaving behind $500,000 in escrow. In order to get that escrow reduction, you are willing to raise the indemnity cap to 50%. So let's say it was 20%, but now you're saying if there's a problem, you can actually sue me for 50% of the amount that you are buying my business for. You get a matching insurance policy, 50%, $5 million of insurance to cover any claim that a buyer might make. The cost of that insurance policy, again, hypothetically, plus or minus 1% of the coverage is what we typically see, at $50,000 with a retention or deductible, same thing, of $20,000. So you've gone from leaving behind $2 million in escrow to leaving behind $500,000 plus the $50,000 premium payment, and maybe you want to hang on to that $20,000 just in case there's a claim. Well, now you walk away with an extra $1.4 million. That's pretty material. There's more to it than just receiving the most proceeds you can, although obviously that's the goal of most sellers. The other advantage really is that you're not getting sued by the buyer necessarily. So I guess I'll just pause here to note that there's really two products that I'm talking about here, because either the buyer can be named as an insured or the seller can be named as an insured. If the buyer is named as an insured, they're not going to sue the seller at all. They're just going to go after their insurer. And then it can be a helpful negotiating tool in negotiating the terms of purchase and sale of a business, because to some extent you care a lot less about the language of the representations and warranties, knowing that your money is not actually on the hook if something's gone wrong. There's benefits to the buyers as well, but I think really for the purposes of the seller in a room full of sellers, what you're talking about here is an escrow reduction, the fact that you don't have to be on the hook for an indemnity, that you can give a little bit on the language of the representations and warranties, and ultimately that you're not responsible for managing the claim. So part of what you get covered under one of these policies is your legal costs to defend a claim. Quick facts. Like I said, there's two different products here that I'm talking about. In terms of price, on a buy-side policy, you're looking at somewhere between 2.2% and 3.5% of the coverage limit. So that's how we express pricing on these things. Depending on how much insurance you're buying, you're paying between 2.2% and 3.5% of that. Plus, there's a fee that the insurers basically pay their own lawyers, depending on the complexity of the file and the diligence. So that's that $35,000 to $50,000 underwriting fee. And then on the sell side, these are what we call simplified policies, tend to be for smaller businesses. I expect a lot of the folks in this session have businesses of this size. This is really anything kind of under $50 million. And the pricing that we tend to see on those is between 0.75% to 2% of the coverage that's being purchased, and there's no underwriting fee on those. In terms of the process, like I said, on the buy side, it's a little bit more involved, because ultimately what you're doing as an insurer is double checking the diligence that a buyer has done. So you're going to review the diligence materials. You're going to set up a call in which you can interview the buyer's advisors to make sure that they've done proper diligence, and then we'll negotiate the policy. All in, you're looking at, you can do this as fast as about 7 to 10 business days. And then on the simplified side, they're much quicker because there's no formal underwrite. And so really all you're doing here is filling out an application with some information about the business. We can put a policy in place in 2 to 3 business days. In terms of claims, because I think this is really kind of the key. This is not like your home and auto type of policy where insurers do everything they can not to pay out. This product really only makes sense for business owners if it pays out. So we see about 1 in 5 policies result in a claims notification, which I suspect is a lot higher than many areas of insurance. The majority of the claims that we see are related to four major buckets, but really it's a financial misstatement, something to do with taxes, something to do with material contracts, or non-compliance with laws. I'll note as well, just on the simplified policies that we offer, most of the claims that we see are actually for legal expenses. And so what that means is these are relatively small claims. Most of the money that is being paid out from the insurer is to cover the legal expenses that a seller incurs in defending a claim. And then in terms of who we go to, who offers these products, it's all the traditional insurers. Many of them have arms that do this. So your Liberties and your Chubbs. But then there's also a whole series of specialized MGAs, which really just means it's a consortium of insurance capital run through a managing general agent. Names that might be familiar to folks here would be a Euclid, Ethos, or an Ambridge. I mentioned at the beginning, we deal generally with representation and warranties insurance, but there's actually other stuff as well. And so if you look at this matrix, what we're kind of looking at here is the unknown, meaning we don't know the source of a breach and we don't know the quantum of damages that are suffered. So that's the rep and warranty insurance on the top left. But if you look at the top right, there's also stuff that we do where it's a known unknown, meaning we know the source of the risk. Could be known litigation, could be a known tax position. We just don't know the quantum. And so in that sphere, we deal with products that we call contingent and tax liability insurance. So those ones are where you can put a specific name to what a liability is or what could cause a liability. Again, it could be litigation, could be something like you've done a pre-closing reorganization. Sometimes it's connected to a transaction. Sometimes it's in the ordinary course of business, but those are also things we can look at. So again, these are the unknown breaches of reps and warranties and purchase agreements. Could be the risk of reassessment by the CRA or penalties for tax structures that are not under audit, meaning it's unknown whether or not they're even going to go under audit at all. But it could also be quantification of known contingent liabilities, known litigation, known regulatory exposure, those sorts of things, or the quantification of penalties for tax structures that are already under audit. It's just that the pricing changes. Obviously, it's more expensive to insure something that is more likely to result in damages. That's it from me. Back over to you, Alex.
Yeah, excellent presentation. Thank you for all the value. As you guys can see, it's important to account for unknowns that might come up and be able to protect yourself and your business from that in your business transition. So I noticed that Rob had answered a few questions in the chat. Thank you. We can see your questions. If you still have some of it, please feel free to type in the chat. But I'll start sharing my screen, and I'll just let me know once you see that. See that? Because I don't see a chat now.
Yes, can see it.
Okay, wonderful. Thank you, Sabrina. So yeah, today we'll cover financial planning and tax planning for business owners prior transition as well as after transition, regardless what type of transaction you have, whether it's external sale to a potential buyer or internal one to pass it down to your employees, or even succession, again, transferring your business to your beneficiaries. We'll review a few strategies, we'll have a case study, and we'll get an understanding how to grow and how to access your wealth if you are a business owner. So if you are a business owner, you have a few buckets where you can accumulate your wealth. You can do it on a personal level where you'll have all the registered investments RSPs, TFSAs, or ESP or DSPs. There are so many of them. You can also have non-registered investments. You can have real estate. Like those are the top 3 ones that you might have. Now, if you have a corporation, you can have pretty much the same ones, but under corporations. And again, the big part of your wealth might come out from the value of your business. And that's where you start asking yourself a question like, can I sell the business? What would be the value of this business and how exactly can I sell it? So it really depends on where you are in your journey. You might be a startup. You will have to kind of account to a few things here. Look at your cash flow, because a lot of times startups, they require more money and they spend more money than they earn. So cash flow is an important item. You want to make sure that your business is protected from potential liability claims and different exposure that you might have. You also need to decide when to incorporate, because you can run the business as a self-employed individual, but at some point you need to incorporate. There are some complexities with that, but also there are some advantages that you can take of the structure. And also want to make sure that you have those like term life disabilities, critical illness insurances, make sure that you and your family is protected. When you grow to a next stage, growth and expansion, that's where you start getting potential new shareholders, new partners. You want to make sure that you have a shareholders agreement. You want to make sure that it's funded. Again, God forbid something happens to one of your partners, they want to leave, health situation, or they pass away. You might have to come up with a large sum of money to buy them out, or be able to accept new shareholders that might not deliver value to your business. At that stage, you can also look at group plans, group benefits, group retirement plans, and you getting a few advantages there as well. First of all, you would grow the value of your business if you were to sell, if you have those in place, because for buyer, it's an indicator that it's a less risky business, it's more mature business. There are tax advantages because employers' contributions to those plans are usually tax deductible. And again, it's less risky because, again, businesses are not exposed to much liability in this case if they have those. Now, if you have a couple of individuals that are key people to your business, you want to make sure that you protect your business as well in case if they leave or they cannot continue working for you anymore. Now, when you're moving on to maturity stage, again, that's where you're looking at the corporate structure, potential holding companies, family trust, etc. You're looking at how to properly allocate your investments inside the business. You're considering something that we call individual pension plans, and basically it's similar to defined benefit pension plan that you can build inside the business. Like for those who know, the defined benefit pension plans, one of the good ones in Canada. Usually government people have those, but again, you can have it inside your business, and sometimes we call it like RSP on steroids, because you get more advantages in IPP rather than RSP. And then you can consider permanent whole life policies. Again, there are many advantages to having those, and we can chat about it later, but those are the things that you usually look at when you're there at the maturity stage. And when you move into a succession or a transition, again, that's where all the experts that are focusing on that have expertise on that, just making sure that you work with those, you're planning ahead of time, 3 to 5 years before transition. That's probably an ideal time to start that process. So how do you structure it? What kind of corporate structure you need to have to allow efficiency? And then again, you're looking at annuities, you're looking at permanent whole life policies, but a lot of times we hear about charitable giving strategies, and there is some planning around that as well that needs to be done to maximize those dollars that you donate, so you can again donate more and get more credits or deductions, depends how you do that. We also have something that we call private company advisory, and this is the department that we have at our firm where we help businesses to raise equities, to raise financing. We do strategic advice on how to enter market, how to expand, how to restructure your business potentially to make it more valuable, and also succession planning too. And we might help you with deal sourcing, like to find a company to buy or find a company to sell. We will do valuations, negotiations, due diligence will help with all of that. Now, tax benefits for incorporations. So usually you have three ones, the main ones. Capital gain exemptions that you can potentially multiply. You can do income split, and you can do tax deferral. So this is the common corporate structure that we see a lot of times. Corporation is owned by a business owner. Potentially they include their spouse. And again, when you sell the business, you as a business owner, you would want to do a share sale, because there you can utilize capital gain exemptions, you can avoid a recapture on capital cost allowance. But you as a buyer of potential business, you want to buy assets. And here, like this slide looks busy, but this is just an illustration in terms of numbers. So we have a business with a fair market value of 4 million, adjusted cost base $100, because that's what usually happens when people incorporate. But they have assets, they have inventory, they have equipment, they have goodwills. And if they were to sell assets, $4 million company, they will end up having only 2.5 million after all the taxes that they have to pay. Now, if they were to sell shares without utilizing capital gain exemptions, they'll end up having 3 million in their pocket. And with utilization of capital gain exemptions, they'll end up having 3.5 million. So right there, you saved yourself approximately $1 million in taxes. Last year, government proposed 2/3 of capital gain inclusion rate, and with that, some businesses were affected. And you'll see here with increased capital gain inclusion rate, all of a sudden, instead of 2.5 million, they would get 2.3, so they'll pay extra 200,000 in taxes. Now, so the questions here are like, how can I increase the value of my business? What would make my business more attractive, and how would I make sure that I sell share instead of assets? So those are the key areas that you can focus on. People who buy businesses, they like recurring sticky cash flow. That would increase your value. That will increase potential multiple that you can sell it for. They like to see diversity in your client relationship as well as supplier relationship. You cannot rely on one or two clients or one or two suppliers. It's a potential risk for your business. Visibility, people need to recognize you, your company, your brand. Help community be out there as much as possible to increase your goodwill potentially. Knowledge of your potential buyers. Start doing research early. Maybe you'll be able to find a strategic buyer for your business that will be willing to pay you more. But again, you need to understand what they're looking for. Clarity of financial statements, again, cannot stress that enough. 3 to 5 years before you sell, start to make sure that they're more clear, they're more transparent for audit companies, for potential buyers, etc. And the final one is management succession plan. Like, nobody wants to buy headache with your human capital in your business. They want to make sure that there is a proper succession plan in place. Now, in terms of corporate structures, you'll see here that this common one that we see a lot of times doesn't have a ton of advantages. Now, if you were to restructure it a little bit, for example, this one, operating company, would have preferred shares owned by business owner to retain control over business, but you add in trust here that has common shares, and that's where you add in beneficiaries, including holding company, including family members. And all of a sudden, instead of just having a creditor protection, you have an access to capital gains exemption, and you can multiply that as well. And now you have a proper setup to sell the company, to have a proper retirement, and potentially pass it down to next generation as well, with your estate and your wealth. One thing to consider is tax on a split income. Again, make sure, like Rob mentioned, make sure that you work with your external professionals too, as well as internal ones, accountants, CFOs, lawyers. They kind of have to be all on the same page, and making sure that they go in the same direction. And for this one specifically, making sure that you're qualifying for that, and your family members qualifying, because you can take advantage of it as well if it's done properly. Now, something for you to consider: if you are a small business and you're generating under 500,000 in revenue, you would be eligible for small business deduction. Depends on the province where you're at. You might pay from 9 to 12% in tax. So if you had investments inside your corporation, like here, again, after 12% tax, for example, you'll end up having 88% of whatever you made, and you can reinvest back inside the corporation. If you were to do it personally, it depends again on the marginal tax bracket, but if you're in a higher one, then you'll lose probably half of it, and that's what you have left to invest in the end of the day. So again, there are some strategies to kind of minimize that small business deduction grind that you'll have, because again, if you make more money, if you have passive income inside the corporation, that will reduce that small business deduction. And there are different strategies how to do that. You can again look at potential shareholder loans and capital dividend accounts that are paying tax-free dividends to shareholders, but again, take advantage of those registered savings that you might have. Utilize individual pension plans that we talked about. Make sure that whoever's managing your savings, your investments, your advisors are doing a proper job, not just by diversifying your portfolios, but also tax planning around that, because you probably know that if you have investments in non-registered accounts, you have to pay taxes every year on those interest income, dividend incomes, capital gains that you're triggering. So make sure you put some focus on that as well. And the final one, probably the most favorite one, permanent whole life policy can help you to achieve that and accumulate more wealth as well over time. Now, if you're a business owner, you have a corporation, and you have personal insurances like disability, critical illness, lives, consider moving them under corporation. Again, you'll have more corporate dollars available to pay for that. Again, if you have a permanent whole life policies, a cash value that is accumulating there is tax exempt, and you can utilize that too. And again, we can help you to review all of that if needed. Some people might argue, what if I'll invest instead of buying a whole life policy? Again, if you look at the end of the day, here's an example of $500,000 investments over 20 years into either or, like non-reg or whole life. You'll end up paying the same amount of money, but at the end of the day, after taxes and everything, you'll have more money with whole life policy rather than investing in non-reg. Again, make sure that you're protecting your human capital. A lot of times people forget that they are the main asset that they have. They insure homes, cars, businesses, etc., but they neglect themselves. Later on, you want to focus on your financial capital so you don't sacrifice in case if something happens. That's the family protection portfolio that you want to look for your parents, for your kids, for yourself. If you're still young, just make sure that you get the term life insurance. You won't pay a ton, but you'll protect your insurability if you decide to convert it later to whole life. Again, make sure that you have updated wills, power of attorneys, etc. But that will be all in the financial planning that needs to be done. Disability, long-term care coverages, those are important as well, and critical illness too. Like, I cannot stress that enough. Stats now that almost like 1 in 2, 1 in 3 people will get some critical condition, heart attack, stroke, cancer. So you don't want to jeopardize that and become dependent potentially. In terms of retirement planning, so once you retire, you're in distribution phase and you have risks. Now time works against you, like you don't have much time to wait until markets bounce back or so. And volatility is not your friend anymore, and you have much more risks potential that you need to account. And that's basically our role when we do planning for businesses, for individuals. We want to make sure that all of that is accounted in the financial plan for you. Now we have a quick case study here, and we changed the names and nature of the business, but we have Frank and Isabel, both are 55 years old, and they have 2 kids, 2 children, and their business, they're looking to sell it in 6 years. And at this point, it's been growing 6% per year, but at this point, they also got some unsolicited offers to sell it for $3 million. So we are projecting that we'll sell it in 6 years for $4 million. And there are questions that they've asked, like how can the tax on sale be minimized? Can they afford their lifestyle in retirement, because they spend quite a bit of money as well, but can they also afford a second home once they retire? So this is their current situation. They have a principal residence. They've done a great job in saving into their RSPs, some value of the business, and their net worth is there as well. On your right hand side, you'll see their corporate information, how much they make, how much they save. And on the personal level, they spend about $17K per month, not including taxes, and they draw about $170 in salary and bonuses. So that's their situation at this point. They make money, they pay taxes, they pay for their expenses, they get some savings, then they save it for their retirement, and then again, they'll pay taxes, they'll pay expenses, and whatever is left will be considered as a net estate. So we've done some very detailed planning for them. We've accounted for those what if market crashes 30% in retirement in this case. That's the most sensitive time for market to go down, because people retire, they don't make money anymore. What if inflation is higher? What if they live longer? Stuff like that. So we've also considered capital gains exemptions and some restructuring there as well. We've kind of adjusted where they pay a little bit less taxes now. And also we've considered individual pension plan with annuity. We've delayed their CPPs and all age, because CPP, some of you might know, you can start as early as 60, but you can delay to 70. It's probably not a lot of money, but at least it's something. Again, we restructured some of their portfolios to avoid triggering unnecessary taxes along the way. With all the planning that we were able to achieve, if they didn't do anything, basically, they'll have 4.9 million in net estate, but by utilizing all of the solutions that we were able to offer to their to them, to their family, along with their accountants and lawyers as well, we managed to increase their net estate by 2.6 million, and that's substantial. So message here: make sure that you do planning ahead of time and you utilize all of those solutions. So to summarize, that's the key areas of your financial plan for you, for your business: cash flow, prepare for unexpected, plan your major expenditures, acquisitions, personally through corporate, plan your retirement, and plan properly, share your wealth with your beneficiaries, with community, with charitable organizations. Because again, like there are a lot of things that you can utilize, and make sure that you're aware of those and you take advantage of that.